Hi, this is James Show with Westpac London's end of day report for Tuesday, July the 17th. Well, there was really only one big story in town today that everyone was waiting for, and that was Bernanke's testimony to the Senate, to be repeated tomorrow in the House, where it was hoped that he would give some sort of hint about imminent further policy easing, most likely involving expansion of the Fed's balance sheet to buy assets, maybe mortgage-backed securities, off the market, a QE3 in other words. We didn't get any such hint, although his commentary certainly acknowledged the deceleration in the US economy. There was nothing really new in his commentary. He talked about the labour market recovery being frustratingly slow. He said the Fed's trying to assess whether the loss of economic momentum is enduring and will do the best it can and try to do no harm to the economy. The Fed's examining the extent to which there's deflation risk and assessing if the job market is stuck in the mud, as he put it. He acknowledged too that using QE tools can bring with it some risk, and deciding to use them involves the decision to use them should not be taken lightly. The bottom line basically is that he's increasingly worried about the economy, but he hasn't yet hinted that they're going to make a further policy response. But he's gone through some of the arguments, for and against it. He talks about policy tools, but he's still reluctant to reveal exactly what those tools might be. He says the Fed is still considering them. On the data front, and we may as well run through the US since we're on there first, the CPI was flat in June. The core CPI was up 0.2%. Basically food was up 0.2%, energy was down 1.4%, including a 2% fall in gasoline prices, and there were lower airfares constraining rises in some other categories. The headline annual CPI, 1.7%, unchanged, but the core rate ticks down a bit to 2.2% year. Industrial production rose 0.4% in June. Manufacturing was up 0.7% on a bounce in auto production, although even excluding cars, there was a 0.6% rise in factories, but it was a 1.9% fall in utility output that constrained the overall IP headline to just 0.4, even though manufacturing was up 0.7. The NAHB, National Association of Home Builders, their latest housing market index rose from 29 to 35 in July. That's the highest it's been since early 2007. It's about half though of its peak at 72 back in 2005. So further evidence that housing has not only found a bit of a floor in the US, but maybe even starting to grow, albeit from a very low base, so it's not really making much contribution to the economy. There were a few other bits and pieces in the US. In Canada, the Bank of Canada held interest rates steady at 1%. They acknowledged that a weaker export performance, because the problems in the global economy was constraining the economy. It wouldn't get back to capacity till the end of next year rather than the first half of next year. But they still said that some modest withdrawal of the present considerable monetary policy stimulus may become appropriate. In other words, they've still got that very slight tightening bias that we don't think they'll be acting on anytime soon, indeed this year. Over to Europe, the German ZEW analyst survey fell again, although not as steeply in July. It was down from 17 to minus 17 to minus 20. But it's third fall in a row, nevertheless. But the current situation assessment fell from 33 to 21. Now, that's its lowest in 2 years, and prior to that, when it previously fell from to around 21, that was the level it was running at in the middle of the second quarter of the recession in 2008. So, yet another indicator pointing to Germany being in recession. And in the UK, we saw a 4 percentage point drop to 2.4% in the CPI. That's the lowest it's been since 2009. And indeed, when the economy was just coming out of recession, and prior to that, when the economy was in recession, we had inflation around 2.4%. So basically, UK is back in recession now, and we've got inflation back down towards 2%. So prima facie case there to argue that you have to be in a recession to achieve the UK's inflation target. Now that's not true, of course, but looking at the numbers, you do get that impression. But certainly it just justifies or provides further validation for the extension of the asset purchase program by the Bank of England recently by another £50 billion. So that's it on the news front. Bernanke's Q&A I think is still going on, so he may still say something exciting. But going into the market close, we had losses in Europe, FTSE down 0.7%, ongoing issues related to that banking situation that we don't like to talk about, it was a factor there. Also the French market down 0.25%, German market pretty much unchanged, Spanish market Spanish market up 0.25%. They had the Italians had a bill auction today that went off quite well, that seems to have created the impression that maybe the sovereigns that have had difficulty in issuing debt might be just finding that things have become a little bit easier for them. Having said that, the Spanish market was down 1% today. That was just ahead of the close. The losses were mitigating into the close. Basically, markets fell very sharply on Bernanke's testimony, then sort of came back a bit during the Q&A when they realised that even though he hadn't said anything new in the testimony, he clearly was worried about the economy. And even though he didn't make a hint about easing, he's going to do it. Just not quite yet, it seems. I mean, next week we get those GDP numbers, which we think are going to be very soft in the second quarter, and will probably include downward revisions to the recent growth profile for America. So if Bernanke doesn't hint at it, maybe the data will just tell us we're going to get it. QE3, I mean. In the US, well, the market was rallying into the text of Bernanke half an hour after the market opened. It fell on the text, and now it's been recovering since then during the Q&A, and it's basically unchanged as I'm speaking at just before 5 o'clock in London. The S&P's down 0.25%, tech stocks unchanged. Okay. The Aussie dollar, 1.026. What's the Aussie at the moment? 1.028, sorry. It's been pushing a little bit higher as the equity markets have recovered a bit, as Bernanke has sounded less like a central banker that is not going to do anything. And in Australia, we had the Reserve Bank board minutes yesterday. On the basis of that, they sounded quite sanguine about things. I think they've got policy about right for the time being. We've dropped the idea of an August rate cut, but we still think they'll cut another 3 times, a couple of times in the fourth quarter, and then again early next year. That'll take the cash rate down to 2.75%. And we've got the Westpac leading index coming up in Australia latest day your time, that's Wednesday. Okay, I'll be back with more tomorrow.